Hi, welcome to the 8th edition of the weekly market roundup. I hope you had a good trading week last week, as did I, because the levels that I specified in the video really worked out and gave us a good deal of P&L, or profit and loss account. So before I start off, remember the coming week is likely to be a little different from the other weeks, and if you stick around with me towards the fag end, I would like to point out why and what action you must basically initiate to be able to cope up with this slight change in plans in the coming week. So I begin as usual with my market roundup, which you will see on your screen coming up right now. The markets, especially the Nifty that is, hit a new all-time high, created a record, and the rally really was good for the bulls. In terms of new highs, the highest statistical beta has been logged on many stocks, and this is something that I have been warning on my social media accounts. If you care to connect with me across my social media accounts, the contact coordinates which will come at the fag end of the video, we can get conversations going, of course. So if you manage to navigate through all that market traffic and static, you would have had a good profitable P&L at the end of the week. And I think the excitement is likely to spill over to the coming week also. And the Nifty, as you see on your screen, has gained 1.09% on a week-on-week basis, whereas the Bank Nifty clearly outperformed with 2.71% on a week-on-week basis. Gold and silver fell on the MCX in spite of the fact that the dollar weakened, which I have been pointing out that a weak dollar is good for emerging markets, including India, and as long as the USD INR remains under pressure, you can expect that the bulls in equity markets in India are likely to continue to party. The fact that bullion fell leads me to believe that risk-on sentiments, which is appetite for greater degree of risk, is likely to persist. The fact that crude oil went up 4.06% is not really very good news. We want crude and natural gas to fall, and natural gas did fall 13.47%. Bond yields basically fell by 0.01%, as you can see, from 5.89% last week to 5.88%. But the velocity of the fall is really easing, so that's another sigh of relief. The market-wide position limits rose from 35.80% in the week before last to 37.23%, which means that traders are building up fresh long and short positions. So gold and silver, which fell along with a weak US dollar, need watching. If they continue to fall in the coming week, that money is possibly likely to come into riskier assets like equities. The volumes graphic on your screen will show you how the market traders continue to basically focus on the uptrust and participated quite heavily in the upside. And the indices and stock futures segment both witnessed good trader participation. The graphic which is coming up on your screen is the basis, which means the difference between the future and the spot prices. It shows you how the bulls and bears were nearly almost equally placed in with a slight advantage towards the bulls, because the basis was marginally changed on a week-on-week basis. So I think that in spite of the fact that the indices rose, the basis did not really fall. Tells you that the bears are basically quite subdued at this point in time and not really showing undue signs of aggression. The MWPL graphic, which is coming up on your screen, is showing a rise for the third week of this derivative cycle. And remember, the coming week is an expiry week. And the trader build-up of open interest continues to rise because trader expectations of further gains are remaining in place. The undertone remains mildly guarded but largely optimistic. So traders are actually expecting that this rally into the markets will persist. The weekly roundup done, I now proceed to the bond markets, the 10-year benchmark yields. I've basically mentioned in my earlier videos that the bond market is a fountainhead of money, and all other asset classes get impacted by the bond markets. And what we did see, as you can see on your screen, the 10-year benchmark bond yield, there was a marginal decline from 5.89% to 5.88%, but the velocity seems to be easing. And should bond yields stop falling, that would be another positive aspects for the coming week for equity markets, in addition to the falling USD INR. Falling bond yields basically tells you that there is scope for more interest rate cuts, and if bond yields were to stop falling, which could actually mean that fixed income investors could have better days ahead, or at least see some sigh of relief from further rate cuts. So keep your ears to the ground on the bond market, and so far so good. We're now going to the US dollar index, or the Dixie. The Dixie rose on 1 out of 5 trading sessions. That was Friday, the last trading day of the week, which is fairly surprising considering the fact that there were so many news media announcements about breakthroughs in the COVID vaccines emanating from the American pharma companies. I would have thought that the Dixie would have risen much more considering the magnitude of the breakthrough in the vaccine announcements. But the fact that the Dixie remained lethargic tells me that the US dollar index is likely to remain under pressure, which is, like I repeat time and again, good for emerging markets, including India. And the same is with industrial commodities, which is base metal. If the US dollar index is likely to remain subdued, the commodity markets, particularly the industrial metals, are likely to remain firm, which is good for cyclical companies in India, metals companies which basically run mines. So I think one needs to watch the 92.12 to 92.18 area as rough and ready support in the coming week, and should it get violated on the downside, I think fresh declines might just open up on the US dollar index. I would expect a sustainable rally only if the bulls manage to take the price above the 93.20 and keep it there, which is more important. Last week I advocated a range between 94.15 on the upside and 91.35 on the downside, which held rather well. In the coming week, I expect, I'm repeating the word here, expect an estimated range between 93.70 on the upside and 91.05 on the downside. The dollar index done. I now proceed to the Bank Nifty, and the Bank Nifty rose on 3 out of 4 trading sessions. Remember, India had a shorter week, and it scaled its highest intraday levels after 27th of February 2020. Wow. As you can see on your charts, the Bank Nifty has actually regained a lot of lost grounds after the post-corona lockdown was imposed. And this means the bulls have recovered the entire losses after March. And the index in the near term has outperformed the Nifty 50, and at least for a minimum of 3 consecutive weeks. And this may remain the course of action even for the coming week, because there are rumblings about private sector banks getting licenses to operate in the banking space, and basically a lot of cleanup in banking is anticipated. Also, there were media reports about NPAs coming down sharply in the coming years, which means the fallout of the COVID lockdown and slowdown in the economy may not be as bad as people expected earlier. Of course, these are expectations and a lot can change, but it'll keep the Bank Nifty buzzing. The index gained 2.71% on a week-on-week basis and is trading comfortably above its 25-day exponential moving average, which you can see. While all the other signs are optimistic, just take a look at the graphic on your screen right now and you will see that there is a mild negative divergence on the chart between the price and the RSI. I've marked the same with 2 blue arrows on the price and 4 blue arrows on the RSI itself. Now these could be early warnings of some consolidation or even some correction, and the correction could be time-wise, which is sideways movement, or it could even be price-wise, which means a slight decline. However, if the bulls manage to push the price higher and maintain the index above the Wednesday's intraday high at 29,785, all doubts will basically disappear and the bulls will be back in command of the market all over again. In the week prior to the last, the index was at number 2 of the most volatile list, whereas last week it fell to number 3, not because the volatility or the statistical beta on the Bank Nifty fell too much, but because individual stock futures gained relatively in beta. Now the range I advocated last week between 30,175 on the upside and 26,750 on the downside held accurately, which is why I told you I'm fairly pleased, because the P&L came from the fact that the markets were within the range that I expected. And as far as the coming week goes, I expect the range, this is an estimate of course, between 30,900 on the upside and 27,550 on the downside. Now going by the statistical beta, I would suggest trading light so as to avoid shocks to your trading capital, because the volatility can be really alarming and higher than what an average retail trader may be able to cope up with. I now come to the Nifty 50 index, very clearly the most liquid traded counter on the NSE and the lowest impact cost out there. Now this index has logged 1.09% gain on a week-on-week basis. It underperformed the Bank Nifty in the near term, and it also, like the Bank Nifty, rose on 3 out of 4 trading sessions. But this index was a little different than the Bank Nifty for the simple reason that it went into an all-time high, unlike the Bank Nifty, which was the highest after 27th of February 2020. And the fact that this index is a broader based index, the relative stability, I'm using the word relative, that means in comparison to the Bank Nifty, can be somewhat lower, both for futures and options traders, which is likely to be a relief somewhat. What you're seeing on your screen on the chart, you would notice how the trading session on Thursday logged an inverted bearish hammer, a hammer turned upside down, red in color, and the markets actually went into a tailspin on Thursday. The intraday high of that day happens to be at 12,963 levels in the spot segment, and if the bulls are to be clearly in command of the sentiments, they must overcome this level on a sustained trading basis in order to remove all doubts that the bulls are any weaker. Unless that really happens, I would always have an element of doubt that the markets could suffer somewhat of a correction. The Nifty currently is in what is known in technical parlance as blue sky zone. It's an area where the indices or counter is in a lifetime high area, where all recent long positions, or basically all long positions, are in the money, and therefore no overhead supply is expected, not at least in very great numbers. Now, in the week before last, the Nifty was at number 6 in the highest statistical beta counters on the NSE, but in the last week it fell to number 11 because stock futures gained in terms of relative volatility. Last week, I advocated a possible range between 13,175 and 12,250 levels, which held accurately, which is where most of our P&L came from, because the markets traded in a range that we thought, both in terms of stocks and the indices. The coming week is likely to see an estimated range between 13,300 to 12,425 levels. Now remember, being at a new all-time high, volatility is likely to be elevated, so fresh trades should be on lower exposure so as to avoid any unpleasant shocks from markets which could basically dovetail without a warning. Now what's good for the bulls is that the coming week is likely to see fewer data releases, economic data releases, which means that data-related volatility is likely to fall. And I think what we need to do is watch out for some unwinding on Friday. I'll come to the fag end of this video as to why this week is a little different than the other weeks and what action you need to take about that. The Nifty 50 index done. I now go to a critical area which a lot of traders and my followers on social media pages find extremely interesting. Stocks that are good for high beta, high impetus players, which means stocks where you take positions in smaller lots but wait for larger price moves, and low beta, low impetus stocks, which you have to basically take exposure in higher lots, but you will see lower price movement in them. Believe me, we traders have different comfort levels depending on our aptitude, our attitude, personalities, risk appetite, pockets, and basically experience in the markets. So we segregate, my statistical data model segregates these counters from high beta, high impetus stocks to low beta, low impetus stocks. And the high beta, high impetus stocks wherein you take smaller exposure with larger price moves expected. The list is led by Bata at number 1, second one being Mahindra and Mahindra, thanks to the big price move we saw last week. Number 3, Jindal Steel. Number 4, Tata Chemical. Number 5, Tata Motors. Now for the low beta, low impetus stocks, which means stocks where you will take higher exposure with lower price movement, is led by Glenmark Pharma, number 2 Hindustan Petroleum Corporation or HPCL, number 3 PVR Cinemas, number 4 Bajaj Auto, and number 5 Indian Oil Corporation. Remember, these stocks can possibly, in case any unexpected news releases, etc., corporate action comes into the public domain, can switch from low beta to high beta list. But that would basically be more of a surprise than a planned kind of change in category. Now for the most important aspect of this video as to why the coming week is different and you need to be very well aware of the situation. Now Friday, my friends, is a half day in the US due to Thanksgiving, which means the US markets will shut early and therefore fewer queues for the Indian markets, especially for hard assets, commodities, etc. But the Indian markets are shut on Monday, which is the 30th of November. So we have a local holiday here. To that extent, the coming Friday, which is 27th of November, will see greater unwinding as compared to any other usual weekend session, because it's a long weekend. Monday is a holiday and Friday is a half day in the US. So risk appetite might just contract unusually more than any other week. And do remember that it's also the expiry week. Therefore, volatility might just be a little higher than usual, which is why, my dear friends, I said you need to take action accordingly in the coming week. This is not your regular week ahead, but it's a little more nervous, a little more edgy, and therefore you need to keep a lighter footprint in terms of exposure levels. Now, coming up on your screen are my contact coordinates, my social media account addresses, where I would love it if you connect with me and we can keep conversations going. You can see the kind of statistical data updates that I keep putting up post-market on Monday to Friday, which will help you become better traders. And we, of course, can keep in touch and exchange ideas. I bid goodbye to you in this video. And I would love to hear from you in the comment section. Do let me know what you think about this video. Feel free to recommend my video to your family and friends. I wish you a very, very profitable week ahead. Do take care of your trades and investments. Thank you for watching me. Bye-bye till we meet again in my next. Thanks.